بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Okay, the topic of this chapter is risk management. So let's start. The financial manager faces multiple sources of risk. So as a company, as a manager in the company, you face many types of risk, right? Such as competition from other companies, market risk, industry change, environmental risk, interest rate risk, exchange risk, and political risk. So as you can see, we have many types of risk that we need to deal with. And one way to deal with those risks is to hedge the risk, okay? Which is the topic of this chapter. So we will talk about hedging in the next few slides, inshallah. Now, some people ask why we need to hedge. By the way, hedge means reduce risk, okay? Does this add value to the company? Why hedge? There is some people, they are against hedge because for two reasons. The first one, hedging is a zero-sum game. So at the end of the hedging, we will have zero profit, right? But we know this is actually, the hedging is not to make a profit. We are actually hedging to reduce risk only. So those people, they argue hedge is not good because we don't have any profit. Also, they argue investors, they can do it, they can do the hedging by themselves. So as a company, we don't need to do hedge. But in real life, we know there is another school saying that hedging is very important because it reduces our risk, my risk. So here we need to understand that the goal of hedge is not to make a profit, but to hedge or to reduce risk. How should a financial manager approach hedging? This is mentioned in the next slide. Here, we will talk about a sensible approach to hedging. Any sensible risk strategy must answer the same 5 questions. So how to do hedging? We need always to ask ourselves 5 questions, and based on the answers, we determine which type of hedging we should do. The first question, what are the major risks that the company faces? And what are the possible consequences? So first of all, as a financial manager, I need to ask myself what are the major risks that we are facing. Is it interest rate risk? Is it exchange risk? What type of risk is it? The risk of increasing oil price? So we need to know what type of risk we have and what is the consequences. What is the result of that risk? Do we have bad results or acceptable results? What do we have? So first of all, you ask these questions. Then, is the company being paid for taking this risk? Do we receive extra profit if we take this risk or not? Then the third question, can the company take any measures to reduce the probability of bad outcome or limit its impact? Can we do something that can reduce our risk or not? Can fairly priced insurance be used to offset any loss? Can we be insurance to offset or to reduce the loss or not? Can edit derivatives such as option or future hedge the risk? So based on those questions, we know where to go. Okay, so you need to see what type of risk you have, what is the nature of risk that you have, what is the outcome of the risk, what will happen because of this risk. Do we receive compensations because of this risk or not? Can we reduce this risk? Okay, can we buy insurance or not? If not, definitely we will go for derivatives, which is this chapter topic. So actually we focus on the last one, which is how to reduce risk using derivatives and hedging. Why hedge? Let's take an example. What is a cereal company in the business of doing? Like they are producing a product efficiently and selling it for a profit, at the same time speculating on the price of sugar, wheat, and other imports for its product. So the answer, we do both. So this company, the cereal company, do both. they produced and selling a product for a profit at the same time. They can hedge on the price of sugars, wheat, and other inputs. Now, risk management strategies. There are three principal ways to manage risk. First of all, increase flexibility. Number two, insurance policies. So one way to reduce risk is to buy insurance. The third one, investment in derivatives. So those are the three strategies that are available for firm to reduce risk. Our focus will be on derivatives. Here in this unit we will learn about many types of derivatives. Okay, let's start with the options. Option is an example of a derivative that can help us to reduce risk. So in this example we will learn how we can reduce risk with options. Okay, Abramovich Incorporation sells crude oil. Since its costs are relatively fixed, fluctuation in the sale price of the crude oil can cause unexpected profit or losses. Okay, and the question is, how might Abramovich hedge this risk? So what's the idea here? We have one company. This company sells oil. Okay, now the cost of producing oil is fixed. For example, the cost of one barrel of oil, let's say the cost is $20. Now any fluctuation or change in the sale price of the oil will cause for us some profit or loss. Again, the company sells oil, crude oil. Okay, and because the costs are fixed, I will give you actually example. Assume the cost of one barrel is $50. Okay, now any change in the sale price will make unexpected profit or loss. For example, if the selling price dropped to $40, we will make a loss of $10 because the cost is 50, right? And the selling price is 40. You will make a loss $10, right? If the cost is still 50 and the price of selling is 100, I will make a profit 50, the remaining. So what's the idea here? We have fixed cost. When you have fixed cost, it means you have a risk. What type of risk you have? You have a risk if the selling price of the oil goes below the cost, then you have a loss. Okay, now how you can reduce the risk or hedge the risk? First of all, how does the price of oil influence revenues? We know for this company they may lose money when a price drop. As I said, if the price goes down, like we will make a loss. Now to hedge the loss, we will buy a put option. The company will buy a put option and they will make a money in the put option when the price drop. Okay, so put options means an option that allow you to sell the oil at the current price, at the high price, which is the current price, and this will reduce your risk. So a company will buy a put option to reduce the risk, and the company will have a natural risk plus put option, which provides a hedge against a price decline. So here this was one example of how we can use option to reduce risk. Basically, if you are selling oil, you buy put option and this will reduce your risk, right? If you are buying oil, not selling, buying oil, then you will buy a call option, and we actually explain it in chapter 23, the difference between put and call. Now let's talk about future contracts. Okay, so a future contract is another example. So we finished from reducing risk with option, then we have a future contracts. This is another strategy or another type of derivatives in order to account for price fluctuations or change. Investors sometimes manage risk by investing in future contracts. So this is another example of derivatives. Okay, we call it future contracts. Basically, this is a contract between two parties, buyer and seller. As a company, if you buy a future contract, it means you are going to buy oil in the future, okay, but using today price. So here we have seller and buyer. The profit for the seller is given by this formula that I highlighted in yellow color. Initial future price minus ultimate market price. The profit for the buyer that I highlighted in a pink color is equal ultimate market price minus initial future price. Okay, we have one example here. Farmer Tom owns a wheat farm and wishes to hedge against a drop in the future price of wheat. What are the positions involved in this hedge? So let's think of this example. This company, they own a wheat farm. They own it, okay? Now, what is the risk that they have? The risk is the price of the wheat in the future will go down, okay? If the price drops, then this considered as a risk because they will sell it at a low price. So what they can do, they can now sell it or sell a future contract for wheat, okay? What does this mean? This contract gives them the option or sell that future contract. This will allow them to sell the wheat in the future, but at today price, okay? So always in an example, when you own something, it means you want to sell it in the future. If you own oil, you want to sell it in the future. If you own anything like gold, you want to sell it in the future. So what you can say, and your risk will be a drop in the price in the future. So what you can do, you can sell always at the current price, but the delivery will be in the future. And actually, astaghfirullah, this is haram. It is forbidden in Islam. And the good things, the good point that we learn all these transactions to avoid it, okay? Okay, so we'll complete. So in this example, the farmer will lose money when the price drops, right? What you can do, you can sell a future contract to make a profit. So this is another example of a future contract, okay? And we are actually done with this example. This is a similar actually to the oil one, because for the oil one, the company owns the oil. They have it, okay? So they are afraid that the future price will drop. That's why they bought put options. So this is one strategy. If you don't want to go for put option, you can buy or sell a future contract, okay? So again, this company owns but it owns something different, not oil. It owns a wheat. They will be afraid that the price will go down at the future. One way to reduce this risk is to sell a future contract. We have also financial futures. Financial futures can be used to hedge. When we say hedge, as I said before, means reduce risk. Can be used to hedge against interest rate risk, exchange rate risk, and price fluctuations. So this is a special type of a future called financial, okay? When we say financial, it means we are talking about interest rate risk or exchange rate risk, which is different from commodity futures. So the previous two examples was commodity futures. One was about oil, one was about wheat. When we say financial from the name, okay, you are talking about interest rate risk and exchange rate risk. Now done with the future contract. A third type called forward contract. Forward contracts similar to future contracts, okay? However, forward contracts have some characteristics which are different from a future contract. Let's read this one. If the terms of a generic future contract don't fit the investor needs, he can instead buy or sell a forward contract. So if the terms of agreement in the future is not suitable for you, for example, the amount in the future is, for example, 100,000 and you don't want to buy 100,000. I mean the amount of oil, let's say we are talking about oil here. For the future, always the term of the agreement is general, okay? I mean is standardized. You need to follow them. When you go to the market to buy oil, future, for example, each future is $100,000 each. A future is for 3 months time. So maturity is only 3 months. So sometimes you cannot find what you want. Let's say you want only $50,000 for oil and you want it only for 1 month. So in this case, you cannot change the future. One way is to buy forward. Forward is specific. You can design it as you want. Okay, so this is a difference between future and forward. They are the same idea. However, a future contract are standardized, but a forward contract is custom or custom designed. Okay, forward contract are custom designed. A future contract, they have a specific amount and expiration date to meet the buyer's need. So this is more suitable for people who want something specific, not something standard. It's like when you go and you buy your car. Most of the car will be standard, right? However, you can make your own option in the car. This is the same. This is will give you to make a specific change for the terms of the contract. Here we have examples of forward contracts. You enter to a forward contract to take delivery of 1 million euros 3 months from now. What happens to the price you will pay at the expiration if you depreciate during the contract? So imagine here you are a company and you want to make a payment equal to 1 million euro in 3 months from now. So assume now you have a loan in euro and in 3 months you need to repay the loan. So if you enter into a contract for forward contracts, the question is how much you will pay. What will happen to the price at the expiration date of the contract? If the euro depreciate, means goes down. Okay, how much you are going to pay? The price of the euro will not change, right? Because you will pay it based on the fixed contract or the fixed price in the contract. So when you enter into actual contract, you don't care about what is going in the market because you have a fixed price in the contract. Like for example, if you're a company in USA and the loan it is in euro, okay, and let's assume the exchange rate between USA or dollars and euro is equal to 1.2. So every euro equal $1.2 a US dollar. Now if in the agreement the price is 1.2, as I said, you don't care what will happen to the price in the market after 3 months. If the change rate after 3 months change, let's say change to 1.5 or 1.6, you don't care because you will pay only 1.2 based on the price in the contract. The last example here is a swap. Okay, so here now we covered until now 4 types. One called options, another one called the future, another one called forward. The last type of the derivatives that can be used for a hedge is a swap. So what common way for firms to hedge against risk is to enter into a swap. So from the name, what do you mean by swap? It is an agreement by two counterparties or two parties, buyer and sellers, to exchange one stream of cash flows for another. So basically here you will exchange, okay, you will swap the payment. I will give you my payment, you give me your payment or your cash. Example, there are famous example always is funding a variable rate obligation with a fixed rate payment. When we say obligation, assume it is loan. Okay, so some loans we know in the real life, some loans will be based on a variable interest rate and some loans will be on the fixed interest rate. So you may have a situation where two firms want to change their payments. Like for example, I am company A and you are company B. I will ask you, can you please give me the payment, fixed payment from your company, and I will give you my variable payment. Okay, why? Because you have some obligations in labor and in variable, and I have some obligations in fixed rate. which is here in this slide, like can be explained in this graph. So assume here we have a company, and here we call it the other party swap dealer. So this company agreed to pay fixed rate payment, okay, which is just one fixed rate payment to the swap dealer. At the same time, the company will receive labor payment from the swap dealer. So this is one way of a swap. You pay them a fixed rate, they pay you a labor payment. Like why you need the labor as a company? Assume you have here a loan in labor. So if your loan is a labor, definitely you need to pay it, or to pay for the loan in labor. So that's why you ask the other firm to pay you labor, so you can pay for the bank in labor at the same time. Now what is labor? Labor called London Interbank overnight rate. It is an interest rate, okay? It is one type of interest rate at which banks can actually borrow from each other. So many future contracts, they are based on labor obligations. Labor is like one type of interest. We call it labor. It always changing. Every 1 week they change it, okay? It goes up and down. That's why we call it a variable. And here we have an example of interest rate swap similar to the previous example, but we include numbers, okay? We have the labor rate. As I said, the labor rate, from the name, labor means variable. It is not fixed. Now we have three scenarios here. Assume labor equal 4.5, 5 and 5.5. Now if you have a loan based on labor, and let's say the amount of loan you have 100 million. Now if the interest rate in the market is 4.5, this is the first scenario. Assume now the interest rate is 4.5. This means you will pay 4.5 million, okay, dollars as interest, which is 4.5. You multiply it by 1 million. This will give you 4.5. So you are paying here only interest rate equal 4.5 million. If the labor is 5, you replace labor that I highlighted in yellow color with a 5, okay, will be 5% multiplied by 1 million. This is 5 million interest. If it is 5.5, it will be 5.5 million interest. So this is how much you pay interest based on the labor. And we have three scenarios. Now assume you entered into a swap contract, okay, and in the agreement you agreed with the other party that you will receive this as a cash payment. You will receive 0.05 minus labor that I highlighted in green color. This is the agreement. Always you will receive 0.05 interest minus labor. Now in the first scenario, labor is 4.5. correct? So replace labor by 4.5. It will be a 0.05 minus 4.5. By the way, 0.05, it means 5% here. 5, okay, minus 4.5, the remaining is 0.5%. So you will pay only here $500 as interest. The second scenario is 0 because the amount will be 0. 5 minus 5, 0. Okay, 5.5 minus 5, it will be minus, right? And you will pay minus 500. This is similar to the previous one. Okay, currency swap. The one we talked about it before, it is here. It was about interest rate swap. Like you may also go for currency swap. Currency swap are a subset of interest rate swap, especially if the loan are priced in different currencies. We will have example in the next slide, inshallah. Now, why would a firm engage in currency swap? Currency swap allow firms to exchange a series of payment in dollar for a series of payment in another currency. Now, to explain this one, read this example. Suppose you have invested in a project in Japan that is financed with the US bonds. Think of this question. You want to invest in a project in Japan, but the money you received it from US, you have it, okay, as a dollar amount. Now, how would a currency swap be useful here? you might enter into a currency swap so that you can eliminate holding Japanese bond, because you are investing in Japanese. You need the yen, not the US dollar. So you will try to find another company who is happy to give you Japanese yen and take US bond from you. You swap the payment, or you can think of it like this. You will try to find a company who wants to open a project in US. If they want to open a project in US, it means they need US dollar. So you give them your US dollar, and you want to open in Japan, then you will take their Japanese yen. Now let's take this example for currency swap. Coca-Cola wishes to borrow yen to finance its Japanese operations. Coca-Cola believes that the term of the loan will be more favorable in the United States. Let's read this again, okay? We need to understand it. Coca-Cola, what they want? They want the yen, okay? Why they want yen? Because they want to open a company in Japan. However, they believe the loan will be easier or cheaper if they take it in United States. Why? Because they are US company. If you are US company, the bank in the US will give you a good loan compared to Japan. So this is a problem. They want yen, but they couldn't take a loan in yen. They took the loan in US dollar. It borrows because they take it in US dollar. How much they borrow? They borrow 50 million US dollar for 4 years at 3%. Then they arrange a swap with a swap dealer to trade to swap the amount, okay? And the rate of the swap based on the agreement, yen is equal 4%. Suppose the spot exchange rate is $1 equal 80 yen. Okay, here in the slide we have tables that shows how the payment will go through the swap. So as I said, Coca-Cola will take a loan in US dollar. So in year 0, they will receive $50 million based on the agreement, okay? They will receive $50 million US. Then every year they need to pay interest rate. The interest rate here in year 1 to 3 is 3%. 3% of 50 million means 1.5 million. This one negative because they will pay interest. They are not receiving. They are paying interest to the bank. So negative 1.5, and at year 4 they will pay the loan plus interest 51.5. So this is just in real life without the agreement. Then in the swap agreement you have two things. Part A, Coca-Cola will receive US dollar, and part B, Coca-Cola will pay yen, okay? So the idea here in part A, they are going to swap the dollar, right? Swap it, they will give it to the another party. That's why it is negative. So the loan that they took from the bank, they take it, then they give it to another party. So this 50 million negative. They will receive the interest rate from the other party 1.5 and the loan at the end, okay, which is 51.5. In part B, they will pay yen. Year 0, if you multiply 80, because this is exchange rate, 80 multiplied by 50 million, this is 400 million yen. They are going to receive. They will be the interest in yen, okay, and at the end there will be the interest plus the loan in the yen. Finally, at the end, the net cash flow will be like this: 400 yen at 0, okay, minus 16 yen at year 1 to 3, and 416 yen in the year 4, okay. So we are done with hedging. There is 4 type of hedging: option, forward contract, future contract, and swap. And the swap 2 types, okay. We have swap, interest rate swap, and we have currency swap. Now let's talk about hedging versus speculating. Our focus on hedging, okay. Hedging means we need to reduce risk. Speculators do little more than gambling speculators, okay. They only look for short-term profit. So some people, they enter the market just to buy and sell, buy and sell, buy and sell, to make a profit. Okay, it's not to reduce risk. However, our focus as company is always to reduce risk. Okay, informed investor should use a derivative for hedging, not speculating. So if you are an informed investor, I mean you don't know too much in investment, you just use the derivative to hedge risk, not to speculate, because this is a very risky derivative, or very risky tools. It is not like stock is riskier than stock or shares. Derivative innovations. Derivatives can be created to hedge against any risk a firm can face. It is not like only a commodity. I mean, we can hedge against any type of risk that you can think of. It is not just for oil or wheat or currency or exchange rate. There is many types. For example, here we have a TV network may want to hedge the risk of the world series games being getting rent out for going advertising income. So imagine if you are a TV network and you are covering, let's say, the World Cup for suckers. Okay, if something happens and they cancel the competition, you may lose the advertising outcomes. So even this type of risk you can hedge for. So in these days you can hedge against any type of risk. Okay, here we have just a chart for the turnover in future contracts, or the volume of future contracts. Most of them is the orange one, which is a financial contract. So in the market, most of the future of the contract are financial contracts like interest rate contract and currency contract. Some of them is commodity contracts like oil. You can see the green is lower than orange. Okay, I think that's all for this chapter. Here we have also another examples of financial and forward contracts in the US market. For example, you have US Treasury notice, contract US Treasury bonds, Euro dollars deposit, and so on. Okay. Anyway, this is for all for this chapter. Thank you so much, and if you have any questions, anything you don't understand, please feel free to post your questions in the discussion board, in the blackboard. And thank you so much. Wassalamu alaikum wa rahmatullah wa barakatuh.